Hi there. So what we're talking about in this video are pages 19 through 25 from the textbook. So for those of you in Monday, Wednesday, Friday class, this is for class 4. You need to watch this video before class 4. If you're in the Tuesday, Thursday class, watch this video before class 3. So it should be linked in your proper to-do folder. So if you're in the right to-do folder, you have the right video. Also, you Tuesday, Thursday folks, this is actually the second video for you. So you should have already watched video 3A about transactions and before you moved on to this one. Alright, class 4, Monday, Wednesday, Friday, 3B for Tuesday, Thursday. Alright, so up to this point we've talked about how accountants are keeping track of information for organizations of different kinds, and we follow some rules called GAAP that we're going to be learning through the years here at A&M Kingsville. Last class, or last video, we learned how to do some transactions, right? We learned that accounting equation A equals L plus E always stays balanced, and we learned that there's some different kinds of accounts called assets, liabilities, and equity, revenues and expenses, and as we apply transactions to those different accounts, we're keeping the equation balanced. And that's how we track the information for the organization. We just keep tracking those transactions. Every time a transaction occurs, we either increase or decrease a side of the equation. All right, now what happens at the end of the period, the month, the day, the year, the quarter, and we want to know, well, what was going on with those transactions? What was the results for our company? Well, that's what this part of the chapter is about. It talks a little bit about financial statements. All right, so this is about financial statements. All right, now financial statements are just the reports that accountants make using the information from all the transactions they've been recording. So all throughout the period, whatever that may be, a month, let's say, the accountant's been tracking all the increases and decreases to the assets, the liabilities, and the owner's equity accounts. Sit down at the end of the month, people want to know stuff like, how did we do? Did we make a profit? Did we make a loss? You know, did our assets go up or down? You know, are we doing well? Right? How's our company doing? Well, as an accountant, you would just make a report. You would say, oh, well, here is this report. And for accountants, our reports are called financial statements. So this first screen here sort of summarizes them. So there's 4 basic statements that we're going to learn how to prepare. So these are the financial accounting, the financial statements. All right. The first one's called the income statement. The second one's called the statement of retained earnings. Third one's called the balance sheet, and fourth one's called statement of cash flows. So we're going to learn all about these in more detail, but for this chapter we're just sort of learning what's on these reports. The income statement followed by the statement of retained earnings. The balance sheet is the third statement prepared, and the statement of cash flows is the final report prepared. We always prepare them in that order, actually. So it's good to learn them in that order, because if you do accounting, you'll actually prepare them in that order, because, well, you need information from the first one to go to the second one. They sort of flow together. So you need the information from the statement, income statement to go to the statement of retained earnings. Then you need that to go on the balance sheet, and then you reconcile the income statement to the balance sheet using that statement of cash flow. So you need them prepared in that order. Which is what this is showing. Financial statements are business documents that are used to communicate information for decision making, right? So you may recall I called them reports. So people call them financial statements, business documents. They're just the reports of all of, they kind of summarize what went on with all those transactions we recorded. So it's important to understand the distinction between them, because once you start actually preparing these reports in class, if you think about what they do, it's easy to remember what information goes on them. So the first one you prepare, always the first one, is called the income statement. And that provides information about profitability for a particular period. Profitability, in other words, do we have a net income? Do we have a loss? Right? The statement of retained earnings tells how much of the company's earnings were retained and reinvested in the company. Just like it sounds, a statement of retained earnings. Well, how much of that earnings do we hold on to? And now it's kind of starting to make sense, right? If we want to know how much of the earnings we retained, don't we need to know the earnings? That's why we prepare the income statement first, to get those earnings so I can figure out, well, how much of those earnings did we retain? The balance sheet reports the business entity's economic resources, right? The assets. The economic resources we call assets. The amount of debt owed to creditors, liabilities. And the net worth of the entity we call equity. The balance sheet shows the financial position. So, if you'll recall, the balance sheet shows the financial position. All right, so if you'll recall, retained earnings was one of those accounts that was under equity. So it should make sense that, oh, we need this information about retained earnings to go on our balance sheet. So that's why they're going in this order, right? All right. So let's go back. We're going to talk about a little more detail on each of these kinds of statements. So we know they're important in order and what they do. Income statement, statement of retained earning, balance sheet. So the income statement reports the net income or losses. So it represents a summary of the business entity's revenues and expenses for a period of time. The income statement tells whether the business generated net income or suffered a net loss. Only revenues and expenses are reported on the income statement. So we've already talked about some other kinds of things going on, right? You remember we talked about some assets, some liability, right? We talked about other stuff that companies are doing, picking out loans, getting accounts receivable, but only revenues and expenses go on this income statement, right? Because not every report is going to have everything on it. That would be you can't have everything on every report. You have to pull out the important stuff. And so for an income statement, the important stuff are the revenues and expenses. All right, so that's all you're going to see on an income statement report if you prepare one. And you will prepare one, so just remember, income statements just have revenues and expenses. All right. The next thing that you prepare, because as you may notice that here we get at the end some net income, right? That's the whole point of doing this. We get revenues minus expenses equals some net income. So the next statement we prepare is a statement of retained earnings. And imagine you own a company and you're like, it's the end of the month or it's the end of the year and you want to know, well, how much did the company give to me this year? Like maybe they didn't give it out, but they earned it or they retained it. How much in that company belongs to me, the owner? That's a statement of retained earnings. The statement of retained earnings shows the changes in retained earnings for a business entity during a time period. The net income or loss from the income statement is transferred from the income statement. Right? So that's why we did that income statement first, because part of what we do is we say, well, what were the retained earnings to begin with? How much did we get this year? And so what are the statement of retained, what's the retained earnings now, right? So when owners want to know, well, how much of that company is mine, in other words, what's retained, they would look at that. And we are only concerned with things that affect retained earnings, which are what the beginning balance was, what we added to them, basically any net income. And if we paid anything out, like dividends, remember how dividends decrease retained earnings? Do pay that. So that's what this statement's about. Figuring out how much retained earnings are going to go on our balance sheet report, right? Because you may recall that retained earnings affect owner's equity, all right? So the balance sheet kind of is going to sound real familiar. This report, this financial statement, the balance sheet lists a business entity's assets, liabilities, and stockholders' equity as of a specific date The balance sheet is a snapshot of the entity. So remember our accounting equation? A equals L plus E? Well, here you go, right? Assets equals liabilities plus equity. And as we know, retained earnings are part of equity, so we have to take that retained earnings and bring it over here. And so now all the transactions that occurred throughout the year, we either reported in summary on that income statement, right, the revenues minus the expenses, or on this balance sheet, assets equals liabilities plus owner's equity. Here they're all summarized. Now there is another statement, and we're going to get to it in like serious detail at the end of the semester. But a GAAP, do you remember GAAP, US GAAP, generally accepted accounting principles? A GAAP compliant set of financial statements includes cash flow statement. So we're not skipping it forever, we're just going to skip it till the end of the semester. But I want to tell you it's out there so we can start keeping it in our brain. This cash flow statement reports the change in cash during the period. The ending cash balance on the statement of cash flows is the same as the ending cash reported on the balance sheet. A statement of cash flows is divided into 3 sections: operating, investing, and financing. And we prepare it last because if you think about it, we need the information from the other 2 statements, right? We need to know the cash from the balance sheet, and we need to know the operating payments, right? We need to know what our net income and all that stuff was. So think of it as a way of following the cash only through the company, which is important, right? Because cash is king, right? You want to keep really good track of the cash. So we prepared this one last because it's reconciling the balance sheet to the income statement in terms of cash. So we got these 4 financial statements. So all for right now, you kind of need to remember on a high level. Income statement equals revenues minus expenses. We're figuring out, did they have net income or net loss? Statement of retained earnings, that's how much was retained by the company. As you start with your old retained earnings, add any net income or subtract any net loss, subtract any dividends, here's your new retained earnings. Then balance sheet, hey, that's our assets equals liabilities plus owner's equity. We do that next. And finally, the fourth statement is the cash flows. We'll get into it in a lot of detail next to last chapter this semester. All right. So another thing I want to start talking about is using the financial statements, right? So it's really great that we're accountants and we learn how to prepare financial statements, and we do that in accordance with US GAAP, and we know the accounting rules. That's great. But the whole point is people are going to make decisions using these financial statements, right? Imagine if you wanted to buy stock in a company, right? I bet some of you maybe already have stock in a company. Well, you need to be able to figure out, is that company doing well? Is that company doing poorly? And a lot of times looking at just one number doesn't tell you much. Sometimes you have to compare them to something. Right? Sometimes you have to say, well, is Coke doing better than Pepsi? Right? So if I want to buy stock in a soda company, should I buy Coke or Pepsi? Right? I might compare their financial statements. Or if I'm the owner of the company and I want to see how I'm doing, maybe I might want to compare last year to the year before and see if we're growing or shrinking or right, doing better or doing worse. Right? So I want to be able to compare. I don't want to just look at a balance sheet as of today. I mean, it's prepared as of today, right? We sit down and we say, what are the assets, what are the liabilities, what are the owner's equity, right? But does that mean anything? If you're just looking at today's balance sheet, all you know is today's assets. Is that more than you had last year? Is it less than you had? If it changed, why did it change? Did it change because you're having great operations and doing well? Or did it change because you borrowed a whole lot of money and bought some more assets and now you have a lot of liabilities too? So a lot of what we have to think about is how do we use these financial statements. So at the end of each chapter there's going to be a little ratio or a tool that we can use to think about the financial statements, all right? So at the end of this chapter, at the end of chapter 1, we were talking about return on assets. And especially those of you who are finance majors, you want to make sure you're thinking about all of these tools to analyze financials. Accountants, we do it too, but definitely anybody who buys stock does it. You just need to understand how to analyze financial statements. It's every bit as important as knowing how to prepare them. So this first thing we're going to talk about is something called return on assets, ROA. Right? So this is a way people tell if a company is doing a good job of using its assets. Right? So you can imagine if you had a building that is a manufacturing building and it's a factory, and this factory and all the equipment in it cost $1 billion. Wow, that's not unusual, right? $1 billion for a factory and all the machines and robots and stuff. You know, you can imagine a car manufacturing factory. Right? Imagine the Mercedes factory making Mercedes. They're huge factories with robots. And $1 billion probably would be inexpensive for the Mercedes factory. So, but is it worth it to spend $1 billion on that factory? Well, how can you tell? You can say, well, how much did we earn using those assets? Right? So if I had $1 billion in assets, but you know, every year I made 100 million, right? And that building, you know, that might be good, right? So one tool we can use is measuring the return on assets. And so to do this, you use this ratio. We call it return on assets. And the formula is net income divided by average total assets. So in other words, you would go to your financial statements and get those numbers. And you would take average total assets, right, and divide it, and you go get net income. So remember, net income is on the income statement. Assets are on the balance sheet, so you need those two reports. Get your net income, divide it by the average total assets, and you'll have some kind of a number. It'll probably be a decimal point, right? Because probably net income is nowhere near as large as the total assets. But you would end up with a number called return on asset, and that would tell you, I'm doing well with my assets, right? So you have to think of what would a good return be. So so if you're earning 10%, right, 0.10, so if your net income divided by average total asset turned out to be 0.1, I think that would be pretty good, right? Because interest rates are like less than 1% right now, right? So if you have an asset making you 10%, that's good. If your net income divided by average total assets turned out to be 0.01, that might not be very good. 1% might not be good. It just can depend on the industry too, you know? So you need to be able to think in terms of, is my company doing well? And that's the point of the financial statements, really, is to then use them to figure out how we're doing. All right, so this is it for the Class 4 video for Monday, Wednesday, Friday people, and this is it for the 3B video for Tuesday, Thursday people. Monday, Wednesday, Friday, you all need to work problems S11 and S16, S111 and S116, bring them to class. Tuesday, Thursday, if you didn't already work S1 through 6 and S1-6 and S1-10, you need to do that. Plus, you need to work the S1-11 and S1-16 and bring them to class. So, in class, we'll work some more problems. Remember, if you're ever having trouble working these homework problems before you come to class, go on to Pearson. All of the homework problems have been programmed into Pearson, and you can go to Pearson and select, let's see, you got to do S1-16. Click on S1-16. It'll walk you through the steps. There's a little click to get a hint or click to get help. So you can actually go to Pearson, My Accounting Lab, click on whichever problem you're having to turn in, and get some help there. It's a great place to go for help on those homework problems. So come to class ready to ask questions about the financial statements. All right, have a great day.